Welcome to Retirement Unlocked with Larry Heller. Your life, your way, unlimited possibilities. Join us as we explore how tailored financial planning and investments can help you navigate life transitions with confidence. Let's dive into this week's episode.
Welcome to the Retirement Unlocked podcast with Larry Heller. Your life, your way, unlimited possibilities. Today, Larry, we're talking about sequence of returns, but for your longtime listeners, they're probably saying, wait a second here. This was the Life Unlimited podcast, and now it is Retirement Unlocked. So we've renamed the show. You want to tell everybody a little bit about why we did this before we get into sequence of returns?
Yeah, so there was a little bit confusion with Life Unlimited. People are thinking sometimes it may be religious oriented. So we wanted to be a little bit more specific that this is really geared towards kind of retirement, investing, financial advice. We are going to have guests that may not relate to retirement on here, but we wanted to kind of be a little bit more focused. So when people are looking for us on podcasts and looking for retirement help and financial planning, they can find us a lot easier than Life Unlimited.
Well, and what a perfect transition into a huge aspect of retirement planning, which is sequence of risk returns. So, all right, where do we even begin here?
Yeah. So, a lot of times when, we start to run financial planning software and retirement projections, we use an expected rate of return based upon their portfolio and their life expectancy. However, one of the things that could come really back into play is when you retire and the amount of money that you're going to earn, especially in the first few years. So the sequence comes into play. And if you're retiring a year that is going to have some down years, it can have a major impact on what you're withdrawing and whether your retirement plan is going to work. And now coming off 2024 and 2023, where the S&P 500 has had its combined best 2 years in 100 years. So now if you're retiring now and you're looking at projections based upon your current portfolio, we want to kind of just caution that the sequence of your returns could impact that based upon what they earn. So let me back up a second. Let's really talk about what is the sequence of the return risk. What is it? What does it mean? Well, it refers to the order of the investment returns you're going to get. So for an example, if your first sequence was you made 9% the first year, 9% the second year, 2% the third year, and minus 4% in year 4, and you just flip them. So now if the first year you were minus 4, then 2, and then 9 and 9, you've made the same rates of return in 4 years, but because of the sequence, your portfolio is going to look different if you had a negative in your first year versus if you had a positive 9 in the first year. So if you are, retiring and you have some bigger numbers, we're going to talk about history in a few minutes. It could be running out of money faster due to the early losses. So it's not just about how much you earn over time, but it's when you earn those during your retirement.
So how I think I need a little bit more clarity because why the sequence of return risk is so important. If you have a down year right at the beginning of retiring, can you just expand on that just a little bit more?
Because let's just say that your portfolio, and we had one of those really bad years right out from the start, and you lost 20% in the first year. Maybe you're a little bit too aggressive in your portfolio, but even if you were in a 60-40, that's not unheard of to have a double-digit year. And what's been happening in the last few years, we're having some big swings. So if you lost 20% the first year, you need to make 25% just to break even again. So, and if you would have even bigger losses, if you had a 40% loss, you would have to make 66% just to break even again. So recouping those losses and trying to avoid those losses in the first year of retirement, although you're not planning on it, that could have an impact on how that looks in your specific retirement, especially if the first few years. So let's talk about some real historical numbers and how this actually played out. So if you were retiring, let's say in the worst possible scenario, the Great Depression, and you retired right before 1929, and for the next 24 years, if your portfolio started with $1 million, and based upon that, let me just double check my numbers here. Hold on 1 second. So if you had $1 million, the returns on the first 4 years before the Great Depressions were -12, -16, -29. So over the 25 years, this portfolio produced an annual withdrawal amount of about $37,000. So, and that's based upon a 5% withdrawal on your year-end balance. But if you are lucky enough to retire in 1975, right after a major recession for 2 years, and the same 24 years, the same 5% over 25 years, you achieved an average annual withdrawal of $160,000. So 2 retirees, 2 different time frames, 2 different sequence of returns. One was able to withdraw a lot more money and live a lot differently than the other. Of course, we hope we're not going to go through another depression, have 4 negative years, but there, you definitely could.
Yeah. We've had podcasts before talking about some of the strategies that you guys have in order to at least, you've used the word moat before, and I don't know if that's applicable.
Reservoir.
The reservoir story. Okay. So is that applicable here? So now you've opened people's eyes that it's very, very important to make sure that you have a really, really good strategy so that in case you are going to get negative returns right when you retire, what are some of the things that you all can do to help mitigate that risk and hopefully make it so that it isn't so impactful?
Yeah. So, I mean, there are a couple of different strategies that you could do for this. One of them, and one of the things that we like to do, is our reservoir strategy. And basically, part of the reservoir strategy is you're keeping 2 to 3 years of your expenses in short-term, cash. What does that allow you to do? Well, basically now, if you had one of those sequences where you had some negatives in the first year, you're not selling from those years. It's still going to impact your overall retirement, but by not having to sell during those years, historically has shown after those 3 years that the portfolio has rebounded to what it was before. So it gives time to at least accumulate that. But if you don't have the cash in a short term and you're now withdrawing during those years, now that's going to even deplete your portfolio even more and have a major impact. So we did full episode on the reservoir strategy, episode 119. So take a look into that and see how that could help when we talk about mitigating sequence of return risk.
So I want you to just dive in, if you don't mind, because I know we did a whole episode on that, and I don't know why I thought it was called moat, dude, but reservoir is way better. So with the reservoir strategy specifically, what are are there other planning implications besides the fact that you're not taking withdrawals and selling your aspects of your portfolio for cash? We talked about this in episode 119. There is a feeling that your clients have when it comes to this. Do you want to talk a little bit about that, or maybe share an example of you guys implementing the reservoir strategy and how that has helped people feel more comfortable in retirement?
Yeah, absolutely. I mean, I don't care how much money you have in when you retire, when you no longer have that spigot coming in of income coming, you're really concerned about what your portfolio is. So just imagine you retired, let's just say with $3 million, and the first year out, you're down 20%. So now you're down to 600,000 on that portfolio. And if you're now withdrawing from it because you need to live on that portfolio is even less. So all of a sudden now, after 1 year, your $3 million portfolio could be less than 2.5 million. So now you start worrying and you're like, people are like, well, I have to stop the bleeding. I have to stop it going down because they're worried about it going down even more. And they're like, well, I can't afford more. So now they're tempted to sell out of some things in equities that are there for their long-term growth, and that just compounds the problem. So by having this short-term reservoir strategy in here, so we can say it doesn't make a difference what happens in the market in years 1, year 2, and 3. The money in the market is geared for 10 plus years. That we also have a secondary reservoir, which is really more fixed income, that would be really geared for years 3 to years 10. So we have plenty of time to let the cycles go through what they need to do and get back to the equity side. So you're really in someone's head, it's really a lot of behavioral kind of thinking. If they know, okay, that's my long-term bucket, it's down 20%, but I'm not touching that for 10 years. I'm not happy, but I can wait the time frame out because I have these other reservoirs. Versus if you don't think of it that way and just looking at your overall portfolio being down, you have much more lack of conviction, and you got a lot more worried in there. So by doing this, we're able to get people to live their lives, not worry about really a downturn right when they start. And that's what the reservoir strategy will provide. And it's definitely worked because we've used it for many, many years with our clients.
I love the fact that, when you're working with, somebody with your qualifications, that when you are turning off that spigot of income coming in and you're good for 10 years, that's got to be a huge stress reliever for your clients, to make it so that they know that they don't have to be looking at the market every single solitary day, because that's 10-year money, right? I'm good for the next 10. So what are some of the other things that we need to be paying attention to with the percentage-based withdrawals? Because you just began that and we talked about the reservoir strategy. Anything else that we want to go there?
Yeah, I mean, there are some other strategies and the percentage-based withdrawals that I've seen out there that, not reservoir strategy, but basically it means you adjust your withdrawals based upon how your portfolio is done each year. So if the portfolio is down, you drop the amount of withdrawals. If you had some very good up years, you could increase withdrawals. So we prefer the reservoir strategy, but that's another way kind of looking at this. So that's one thing to look at. And we do talk about 25-year timeframes, and we talked about the Great Depression, and we talked about 1975, right after a bear market. And historically, through even before the Depression through 2023, they're a 60-40 model, 60% equities, 40% bonds, based upon a 4% withdrawal rate. You've never run out of money. So during those 25-year time frame, doesn't mean your portfolio hasn't gone way down. Doesn't mean that there's not going to be a time going forward for 25 years that it will happen. But so that's just kind of an idea. So that's on a 60-40 blend, and that's going to zero. Of course, if you start seeing your portfolio going down a lot, you're not going to be happy as well. But so that's kind of really where a starting point as far as what the withdrawal rates are. So of course, depending upon now, if you're 60 years old and you're retiring, 25 years may not be sufficient, because that only brings you to the mid 80s and people are living longer. So you got to be a little bit careful and just looking at the historical data and what that tells you and what the withdrawal rate. You want to factor in a lot of other things, your longevity history, what inflation is. kind of what's been happening the last few years and look at that withdrawal rate. And then as you get older, we talk about people when they're older and, they don't want to take the money with you. When can they have a higher withdrawal rate than 4%? So it's a good guideline to start with, but everyone is different. Everyone is unique. Some people want to plan to age 100. So you're planning for almost 40 years. Some people say, I'm not going to live past 85, no matter what. I have no good family history. So everyone is customizable as we go.
Okay. All right. So let's talk about some of the key tips and the big takeaways for our audience today to manage the sequence of return risk.
Yep. So we mentioned a couple of them, but one of them is obviously stay balanced with your mix of stocks, equities, and bonds, as well as, as cash, our reservoir strategy. In other words, don't panic when that's going through. We've had a couple of times during my career where we've had some major downturns. 2000 is one of them. And we have clients who are retired and they're thinking about, again, stopping the bleeding because they've seen some big downturns. And that's kind of the worst thing you want to do. I've even seen some people that I know just entirely get out of the stock market.
Yep.
So, because they just couldn't live with the swings, and they adjusted their life and they adjusted their expenses to live on a lot less because they wanted to stop the downturns on that. And that's kind of the worst thing that you can do. And that's why we talked about the reservoir strategy. The other step, another tip is rebalance the portfolio back to your target allocation regularly. So what does that mean? So if you have 40% in equities and the stock market has had like 2 great years, like we just talked about. So now your allocation to equities has gone up. We want to rebalance that back down. So what are we actually doing now? We're selling high, and now we're replenishing the money that you took out of your reservoir, your short-term reservoir, when the market is up higher. And same thing on the flip side. Even if you're retired and there's been some years where the stock market is down and maybe your bond portfolio is up, we may want to take some money from the bonds and move that into equities, even in retirement. So rebalancing regularly, we look at it quarterly just to see what your allocation is. Maybe we'll rebalance once or twice a year, but we're constantly looking at it. And it's a hard concept because people are like, why are you selling this? This is doing great. It's making a lot of money. Why are we getting into this? And then why are we going into this? Because this fund did nothing this year. And again, behavioral, sell high, buy low. So, and then, is kind of going through this, avoid panic selling during the market downturns. So again, harder to do when you're retired and you don't have more money coming in, but you really want to avoid panic selling during the market downturns. And that's one of the big reasons that a lot of people hire us, because we're looking at it a lot more objectively than someone when yourself and you're looking at it on your own and it's your own money. So we can guide you through avoiding these panic selling at the wrong time. And also focusing on long-term outcomes. Don't focus on the short-term volatility. A lot of times when we have new clients and we've set them up, we've put the reservoir strategy in and we're talking about long-term, we'll basically tell them, don't watch the news. Don't watch CNBC because they're focusing on literally what are the earnings of these companies for the last quarter. And they're talking about, oh, the market was down 1,000 points today. That's not going to do you any good. So focus on long-term outcomes rather than the short-term volatility. So, overall, the sequence of return risk is a real risk, but retirees don't need to live by fear. By understanding the concepts, making informed adjustments to the withdrawal strategy, they can really significantly improve their chances of maintaining their current retirement income and their lifestyle all throughout retirement.
I love the fact that you brought up the whole psychological component of this because, well, one, that's very near and dear to my heart, but it is so vitally important when you actually hire an objective third person who does this and actually is paying attention to it so that you can really pay attention to what you should be paying attention to, which, by the way, is living your retirement dreams, right? I think that's really, really important. And I just want to recall, or for the audience to think about a couple episodes that we've done previously that will accentuate a lot of the stuff that Larry has just been talking about today. Episode 136, which is Are You Spending Enough? Which is an interesting kind of a partner podcast to this one, because again, if you know what your sequence of risks are, or sequence of return risks are, there can be adjustments, and sometimes they can actually be in your favor. And then
let's just talk about that for 1 second.
Oh, yeah,
That's a great episode, because believe it or not, most people, when we run these run retirement plans for them and show them, they're spending less than they can. And we're telling, more often than not, we're telling people you can spend more money. So listen to that episode if you think you're one of those people that may be spending not enough during retirement.
And again, I think this is one of the difference makers with you, Larry, is you have those conversations with your clients, which I think that there are many advisors who don't. And then there's episode 164, which is Why Distribution Strategy Demands More Attention in Retirement. You touched on a little bit of that with the reallocation of the portfolio. Is there anything you want to add there before we wrap up?
Yeah, because not only reallocation portfolio, but where you're taking the money out. If you have, let's say, your fixed income, your income distributions or income sources such as Social Security and maybe a pension, but then you have your qualified assets. So you have retirement assets you haven't paid taxes on, and then you have your non-qualified assets, and maybe you have a Roth account. Which account that you would draw on when can also have an impact on your retirement success. So we have a whole podcast that talks about the distribution strategy.
All right, Larry, final thoughts before we wrap up.
Yeah, again, the sequence of return risk is real, so you should be aware of that, so you understand when you retire about that risk. But there are definitely strategies you can put in place to minimize that risk, and you live your life unlimited and to enjoy your retirement.
Well, thanks for listening to the Retirement Unlocked with Larry Heller. Ready to take the next step to your retirement possibilities? Subscribe to the podcast, share the episode, and of course, go visit hellerwealthmanagement.com for so many more resources. And for Larry and everybody at Heller Wealth Management, this is Matt Halloran. We'll see you on the other side of the mic very soon.